Good morning. I believe we are live. It still says preparing. We are
Yeah, it says
streaming. We're streaming now.
no, not according to YouTube.
All right. Well, we're live on Facebook. So we're going to take it as a live
Okay.
and hopefully it's all going. So, good morning. Welcome back to the Money Advantage podcast. This is Rachel Marshall and Bruce Wayner. Today we are talking about a popular life insurance strategy called buy term, invest the difference. Now, if you are in any way, at any point in your life, if you've ever looked for whole or for life insurance in general, if you've ever said, let me figure out how to get a life insurance policy that will pay out to take care of my kids if something happens to me. If you've ever addressed that concern, then you've probably encountered this mantra, this idea called buy term, invest the difference. Today, we're unpacking what that means and where it came from, and really what the concerns are or the pitfalls of this popular strategy. And so, Bruce, I'm really excited for this conversation today. I think this term alone, buy term, invest the difference, 5 words, has caused more confusion in the life insurance space than I would like to admit. I think it very quickly leads people to form a very brief opinion about something that they really don't understand or have not thought through fully. And so, our goal today is really just to be able to help you think through what your options are, what the opposite of buy term invest the difference is, and really what the implications or the results are in your life if you go down this path of buy term invest the difference, and really what that means and what can happen as a result. So, Bruce, I'd love your thoughts before we kind of dive into what the lay of the land is and this conversation in general.
Yeah, I think if you go back in history, the origin of this, many people believe, is from Art Williams. And Art Williams, in the it was either the late 60s or early 70s, his father died. And we've talked about this on the show before. It was commonplace uh, prior to the advent of the 401k that people stored money in cash valued life insurance, specifically whole life. And Art Williams' father died prematurely, and did have a whole life insurance policy. And Art was very disappointed, and to some extent, I understand this because he saw his mother struggling because the death benefit from the whole life insurance was considerably less than if he would have had a term insurance policy. And as Art said, it was a lot cheaper that he could have purchased. So he said the insurance agent sold him the wrong policy, and he made it his life mission to eliminate every whole life policy out there, no matter what the strategy was, and replace it with term. And then coincidentally, you gotta wonder his motives. He also then partnered up with a mutual fund company, and thus the entire thing of buy term, invest the difference into mutual funds was actually born. And he built this huge company up, then later sold it. And that mantra continued through the 80s. That company now is not quite as prevalent as it used to be, maybe because Art no longer owns it and they've lost a little steam. But that's kind of the origin of the buy term invest the difference. It was really because of one man that felt like his particular father and mother they had the wrong strategy and caused them turmoil, and it did, but it doesn't mean that that's right for everybody, or that
Mm.
the strategy could have been tweaked just a little bit, and you would have the best of both worlds.
This reminds me of the idea that if you look at one piece of a puzzle and then try to say this one thing fits for everyone else, you're going to end up leading people astray. And I was specifically thinking about in my devotions, we were diving into just some concepts where if you look at, well, Jesus healed a particular way, he laid hands on somebody in one case. Well, you could say, well, that's the only way that you're supposed to be able to bless others is to lay hands on them. You could say, well, he had this person, he spit in their eyes, and that's what caused them to become healed. You could say, well, that's the only way it can happen. And if you take a tactic or a method and then try to say, this is the one way that everyone needs to do it, you're following the wrong piece and you're not really understanding the bigger picture. So Bruce, I really appreciate you sharing that story, because we can never take one person's experience and say this is what needs to happen for everyone. So if you are in this position of considering life insurance, let's just give a very, very quick overlay of what exactly buy term invest, the difference, what those terms actually mean, and kind of what is behind that. So Bruce, as you said, a lot of people used to invest, or not invest, let me just take that word out of my vocabulary here. So a lot of people used to use whole life insurance as a savings tool. And this has been for over 100 years through many economic cycles, booms, busts, through the Great Depression, through challenges and hardships. People would save in tools that allowed them to have safety, where their money wasn't going to drop in value and they had access to capital. And so life insurance, whole life insurance specifically, was a primary tool that people used to do that. Now, whole life insurance, generally, if you think about what the idea of whole life insurance is, it lasts your whole life. You purchase it today, and then that policy will be in effect your whole life and provide a death benefit at the point you die. If you die along the way, and if you're still living at the end of that policy, which today they put that at age 121, it used to be age 100. But if you die before that, you will get the death, your family will get the death benefit payout. If you are still alive at that end of the policy, they'll pay you out the death benefit. So you're going to get a payout with whole life insurance. There's also an equity component where you're building up cash value inside the policy. Now, when you look at that as a savings tool, people were using it also for the living benefit or the cash value. What happened then is, Bruce, you mentioned this story of this gentleman who found out that he could have had a cheaper policy with more death benefit. And that's where he was saying, well, term insurance would have accomplished that. What is term insurance? Term insurance has a short time frame. It can be 10 years, 20 years, 25, 30 years, 15 years. There's a short window of time that you're purchasing coverage, so that if you die during that time, then the death benefits pay out to your heirs or to your family. There's no equity component, so you cannot access any of the cash value. There is no cash value to access and use along the way. So the conversation or the dialogue, the comparison or the contrast we're looking at here is whole life insurance versus term life insurance, and use the savings to put into investments. Now, there's a whole lot of additional history that Bruce will uncover and unpack in another episode. We've talked about this as well in the past, but through the 70s and 80s, some of the conversations and the challenges that were around life insurance, and some of the new products with variable life and universal life and indexed or equity indexed life insurance. There was so many different types of insurance that were that came on the scene during that time frame. We're going to leave that for mostly another conversation. But when we look at two ends of the spectrum, we have whole life, term life. And that's the comparison that we're really talking about today. Whole life being put a lot of capital into a policy, build equity, and then get the death benefit payout whenever you pass away. Term life, short time frame, way lower cost of premium, death benefit that pays out if you die during the time frame, no equity. So that's the contrast. And when the conversation comes about, the idea is, well, if the two things are equal, if we're just looking at get $1 million of death benefit, which policy costs more? Well, whole life is going to cost you a lot more for 100 or for $1 million of death benefit than term insurance. But if that's all we're looking at, it's easy to say, well, term would be cheaper. We're going to save money if we buy the term policy, and then let's go ahead and use the savings and put that over into investments. And the idea with that is, well, if you can get a higher rate of return over here on your savings that you saved from not putting the money into the life insurance policy, put that somewhere into investments, you're going to end up ahead in the long run with a higher rate of return, more capital in the end, better ability to retire. And there is some idea and some merit to this when you say, well, if I'm great at investing and I am really excellent at choosing wise investments, and I can lower that cost of insurance or the premium put into a life insurance policy, separate out the two issues and say, let's put our insurance money here and let's put our investments beside that. You could do very well with investments. But what we're going to do today is unpack what that difference, that contrast between whole life insurance over here and term life insurance plus investing over here, and really what those pitfalls are of that very popular mantra that's become like a buzzword in our culture and society, where people just say whole life insurance, nope, buy term, invest the difference. And that typically generally means, oh, well, I'm just going to accept at face value that it must be the more logical route because I'm going to save money on premium for the life insurance and I'm going to have all this money to invest. It's clearly, or seems as logically, a superior strategy, and it's not really so. So we're going to talk about why it's not really so today. Bruce, anything else you want to add to that scope or the lay of the land? What is the contrast? What is the debate?
Well, before I go there, I think LIMRA, which is the Life Insurance Regulatory Authority, they actually compile statistics, and 52% of Americans have life insurance. However, of those 52%, they feel that 78% of that 52% feel more financially secure that because they do have life insurance. So the first thing I'd like to say is that it's interesting that people feel more secure by a lot if they have life insurance, but only 52% actually have life insurance. So it would seem that then why don't more people have life insurance? Well, the first thing that Limmer found out through questions is that 82% of all people that are asked about the cost of life insurance overestimate the cost. They think it's 82%? A lot more, 82%. So wow. They think it's a lot more expensive than what it actually is. I've always, I've been doing this since the 80s, and excuse me. And I really believe that people, when they're looking at life insurance, they believe they should have life insurance, just like they know they should have car insurance and homeowners insurance and renters insurance and all these other insurance. But life insurance, I believe, is the hardest one to buy because you have to face your own mortality. And when you face your own mortality, you do not want to think about the possibility that you're going to die. And so I think that's one of the more difficult things on this. So I think the time period, so that people understand that the buy term and invest the difference only works if you actually invest the difference. And this is a problem that I've heard from advisors that actually do this strategy, that they complain that, and they don't even know that it's kind of weird that they're complaining about this, that their people are not investing the difference. They change their goals. They decide, oh, it's really buy term and spend the difference.
I was going to say, because of Parkinson's law that we've unpacked on this show, the idea that if you have this extra income, it's very easy for your expenses to rise to meet that income if you don't have a superior strategy or if you don't have an alternative plan already in place.
Now, does that mean that that shouldn't be the strategy? No, it just means that you have to have a better advisor. But I think the number one problem with buying term and investing a difference is that people assume their investments are going to get to a point where they're calling it self-insured. I no longer need an additional death benefit of $1 million, $2 million, $3 million. First of all, I think that's kind of odd because it's not that you need it, but you may want it for your loved one. There's no such thing as being self-insured because your investments are not guaranteed to stay where they are. And we've seen that in a variety of recessions, the Great Recession being a great one. So let's just say in 2008, you were coming up at the end of your 20-year term or your 30-year term, and you were feeling really good about it because your investment portfolio was, let's just, so I can put numbers to this, let's say your investment portfolio was $2 million, and now your $2 million term was going to lapse, and it was going to go away. And let's say it even did go away. You said, hey, look at this. It's nice. $2 million. I don't have to worry about this anymore. I'm not going to pay my term policy. You didn't pay it. And now 3 weeks later, the recession hits and your $2 million turns into $1 million, because many people did lose 50% of their portfolio at that time. Well, now, if you even thought about the strategy, I'm going to go back and get term until I build it back up. You are now 30 years older. The term insurance is going to be a lot more expensive if you can even get it. And if you now die before that portfolio builds back up, your loved ones will not receive the amount of money that they thought to have a comfortable life. That's why you can never say you're self-insured, because insurance is a guarantee for you and your loved ones, where the investments are not.
Mm-hmm.
Now, I'm not saying it can't happen, because if you did this strategy and you retired in 2015, then the strategy actually worked. If you're just thinking about buying term and having all the money possible to put in investments, I'm still not saying you can be self-insured, but I'm saying that strategy actually worked. So you have to look at the time period of when you're actually doing this strategy. And I just had a client just yesterday that said she's extremely nervous with her $500,000 of money in the market. And she said, I don't want to lose half of it. And so this is what people have to overcome, because that is not a sure thing. Your investment accounts are not a sure thing. Now, remember, we always talk about safety, liquidity, and growth. So you don't get all three of those in one particular investment. So that is why the investment part of it does not have the safety aspect of it. And that's why this strategy can work. But most of the people, I would say, just like they say, feel more secure. 78% of people feel more secure with life insurance. Well, knowing you have whole life insurance means you're going to have it for your whole life. So that means you're going to have it for your whole life and feel the most secure. And then finally, I'll just say our podcast friend, Dr. Wade Pfau, has actually done mathematical research on this, plus qualitative research from interviews with people. And having a whole life insurance policy will actually enhance your equity portfolio because of sequence of return risk. And we're not going to get into that. We actually have a podcast on that, and you can listen to Dr. Wade Pfau's podcast with us, and it's a better explanation. But I think those are some of the thoughts we can actually build on right now, Rachel.
Absolutely. I mean, there's so much in this whole conversation. And so let's go ahead, and I'm going to cover a couple of additional pieces here, because what's really interesting is that if you look at the idea of feeling more financially secure, the reason you feel more financially secure when you have life insurance in place is because you have that guarantee. The guarantee that there will be somebody else taking on your risk of passing away at any point in time, and guaranteeing that they'll pay out the death benefit as long as you fulfill your end of the contract and pay your premiums. Now, what happens is that if you look at it logically, let's just imagine a short-term life insurance policy. If you had a term policy for 5 years, say you're a healthy 25-year-old right now, and you buy a 5-year term life insurance policy, the likelihood of you passing away during that time frame, especially if you go through underwriting and you get a preferred or even a standard rating, the likelihood of you passing away is very low. Now, the insurance company looks at that and they call that a mortality risk, and they assess that. And so they're going to say, well, you are not going to have to contribute very much into the pool of premiums that everyone's paying in order for us to hedge or to back up our guarantee that we'll pay out this death benefit if you die during that term, because we think it's really unlikely. They're looking statistically and at all of the health factors of the people that they're insuring, and they're saying the likelihood of death is low. Now, if you extend that out for 20 years and you say, what is the premium that's going to be required for that term insurance policy? Let's just say it's the same death benefit, $1 million death benefit. You're getting either for 5 years or you're getting $1 million death benefit for, I don't know what I said, 20 or 30. We'll just say 20 years. The longer the time frame, the more likely you are to pass away because it's extending towards the end of someone's lifespan. And the longer you progress through life, the higher likelihood of death is. And we know that that's a statistical fact because people have an average age of passing away, and it's usually not very, very young. And so if you can imagine then extending, say you're 25 years old and you get a policy that's a 50-year term policy, which I've never seen that. Have you seen that, Bruce? 50-year term?
No, no.
I
I
didn't think so.
I believe the longest one I've seen offered is 40 years.
Okay.
Um, but doesn't mean it doesn't exist, but I haven't seen one.
Sure. So what we're seeing is if you said, well, let's get a 50-year term policy that doesn't really exist, but I'm 25 now, 50 years, I'm going to be 75, the likelihood of passing away during that term is much more likely than the likelihood of dying during the first 5 years. And so the insurance company is going to say, well, I'm going to charge you more for that. And the way that term insurance premium is set up is that you pay, if you're purchasing whatever that term is, you're going to pay a fixed amount of premium during that time frame of the policy. That doesn't mean that the risk is equal throughout the lifetime of that policy, but it means that you already know upfront, when I purchase this time frame of a policy, I'm going to pay the same cost every year or every month until the end of that term. And what happens at the end of the term is that if you wanted to renew that term insurance policy, you're going to pay a lot higher premium because the time frame that you're within is much closer to the end of your life. So when we look at that whole idea, it makes sense why term costs less because less people are passing away during the time of their term policy, whereas everybody who owns a whole life policy throughout their entire life is passing away during the time frame of their policy. And so that is simply just not even an apples to apples comparison when you look at the idea of the short time frame versus the long time frame of whole life insurance. And the main thing that I want to point out with that is because term ends and whole life lasts, because of that reason, you're in a position where when you have the whole life insurance coverage, you have that security for your whole life, which then means that security, that feeling of financial security, you're able to make better decisions. You're able to have more guarantees during that time frame, and you have the option of maintaining the coverage because you've already set that coverage in place. Whereas if you have a term policy, your option to keep coverage in place your whole life and maintain that long-term complete life guarantee that no matter when I die along the continuum of my years from now until the end, I'll get paid out. There's not a guarantee that you'll have the same amount of premium with that term policy. I'm not sure if I'm communicating that clearly, but not only are you having the longer span of financial security, you also have the guarantee that your cost is not going to increase during that time frame in order to keep it in place.
Yeah, our friend Todd Langford has actually run comparisons on this, both the cost of the insurance, the term insurance, and the possible payouts. He's also then said, don't forget with the investments, you also have to pay taxes on the investment, where you can access whole life insurance, cash value, tax free. And then when you die, the investments could possibly, depending on what type of investments, you could get a step up in basis of them if they're actually in a qualified plan. The Secure Act 2.0 actually made it a much more onerous taxation on the next generation. So you also have to take those into consideration of what you're trying to accomplish. I actually prepared something today, Rachel, really related to what you were saying. Is I don't think people realize that at the very beginning, term insurance was just 1 year insurance. So it was what was called 1 year renewable term. So the actuaries actually said a 25-year-old has this probability of dying. So we're gonna actually charge X amount. The next year, then they said the 26-year-old is a little bit more likely to die because they're closer to mortality. We're going to charge X plus a little bit more, and so on and so forth. And so it actually was like a reverse pyramid. The premium payment kept getting larger, larger, and larger. And what the insurance companies found is at a certain point, people said, well, I'm not paying this big insurance cost anymore because it's just too much in my family budget, and they would drop it. So they were losing premium coming in. So that's when they actually went to the 10-year, the 15-year, the 20-year, the 25, the 30-year, because what they then determined is yes, they're going to have to charge more at the beginning, but because they got more at the beginning, they didn't have to charge as much at the end. Well, guess what? That's exactly what whole life does. And that's why it's much more expensive relative to what people think at the beginning, because the cost of the base premium does not change for your whole life. And so I would argue, yes, whole life is more expensive at the beginning, but it gets ridiculously inexpensive towards the end. And because they have actually had more of the premium at the beginning to actually then uh, make it work for the company, which then the mutual policyholders actually benefit from that.
Mm-hmm.
I've said this before, and it got misconstrued on the podcast. What whole life insurance companies really do is they buy term and they invest the difference. They invest your premium dollars and they invest it in a fixed income. And that fixed income then is going to develop a dividend for you. Oh, and by the way, it's a tax-free dividend. So it has the same kind of characteristics. But what I wanted to show people, if you're on YouTube, now I can share this and you can see it. This is a 39-year-old female, and it was a 20-year term. And you can see that the premium is $1,150 for $1 million. And frankly, this is one of our clients. This is one of the Money Advantage clients, and they were actually did a whole life policy, but then they said, I want to add term to it because I want to get closer to my human life value. And the idea is this is actually a little more expensive term than you can buy on the open market because it has another aspect of it. You can convert it at any time before age 65 without any medical underwriting. So it has an additional feature to it. So it's a little more expensive than if you were just go buy a term that didn't have this convertibility possibility. Then
And
as
that
we stroll,
convertibility, I don't mean to derail the whole conversation, but the convertibility is so valuable because you don't have to go through underwriting again to be able to convert. So even if you had health concerns crop up during the time frame between starting that term policy and the desire to convert it over into whole life, you don't have to go through underwriting. You can just convert off a chunk of that term policy and you have that. I mean, you could almost call it guaranteed underwriting because you've already gone through underwriting before and you don't need to go through it again. So super powerful strategy if you're adding on term insurance.
yes, and then let's say you don't even convert it. Now you get to age 58, and that's where the 20-year term ends. The next year, the premium goes from 1,150 to $12,000, then the $13,000, and then this 14, and so on and so forth. We get all the way down here to um, age 78, and it's $87,000. We get to mortality, past mortality. Now, all of a sudden, if you notice, at age 81, your cumulative premiums are actually more than the death benefit. And people will say, see, I told you this isn't a good deal. Well, we agree. That's why we say you shouldn't do it like this. But however, this actually happens to a lot of people when they have this. We actually had a dentist out in Escondido, California, that actually called the Money Advantage, and I had a meeting with him, and he was 74 years old, and his term had run out 4 years prior at age 70. And we started doing an analysis, and he had some health issues and he couldn't get any more. So he was actually paying over $100,000 a year for $800,000 of death benefit.
Mm.
And then it kept going up. And as you can see, just in this time period between here and here, that's $1 million of premium in only 6 years or 7 years, 7 years. But
So
he felt like,
in this case, you'd be penalized for living longer. If you wanted to maintain term coverage and you lived until age 91 or 95 or 102, you would be in a position where it wouldn't make sense because financially you'd pay more to keep your coverage than you're going to get paid out in death benefit.
well, you could say, yes, it doesn't make sense if you start that from the original strategy. But when you get to age 84 and you've already put in a 1.6 million, if you just stop you don't get anything. But if
That's
you
true.
then say, well, I'm going to put in another 25,000, 225,000, because at least now I've paid in 1.8. If I just stop, I'm going to lose 1.8. But if I continue, at least I'm going to recoup $1 million of the 1.8.
Hmm.
And that is the example I've given with the hot air balloon. This is what happens with these term policies is it's like a hot air balloon. It's going up, the premium's getting higher and higher and higher, and now all of a sudden the hot air balloon catches on fire. And you're like, well, I can't stay in the balloon because I'm going to die from the fire, but I can't jump out because I'm too high off the ground and I'm going to die. So you're really in a position where neither situation, neither decision is really good for you.
Hmm.
And that is why when you do term insurance, especially at a young age, a lot of people cannot visualize that their own mortality, and they may need, or frankly they may want to have the death benefit. And the other thing that they have always heard is, well, over a long period of time the investments are going to average 7, 8, 9, 10%. But once again, now we come back to the time period. What
Hmm.
is your time period? Not over the long period of time. What is your time period? And that is called sequence of return risk.
Yes, I feel like there's so much more we could unpack, Bruce. That was just such a powerful visual to be able to see those actual numbers. And I want you to take one thing away if you're watching and listening. We're not saying term insurance is bad, because you want to be in a position where you're getting as much death benefit as you can, and you're using whole life insurance to be able to build up that cash value and have accessible capital during your lifetime. And also making sure you have enough death benefit that if you were to pass away, you're in a position where your family's going to get as much as possible to cover your human life value. That's HLV, or economic human life value. What that means is the amount of money that you would have made if you continued working in your capacity that you're in right now throughout the rest of your life, making sure that all of that economic value is transferred to your family if you were to no longer be here to produce that on your own. So let's talk really quickly about the idea, Bruce, you touched on here with the sequence of risk returns. When you put money into a whole life insurance policy, you have a guarantee at a very minimum, especially, I want to clarify something. If it's specially designed and ideally designed, you're going to have even more advantages and benefits. But just even a bare bones, typical whole life insurance policy, you are going to have a rising cash value that's guaranteed to be a certain dollar amount or more at a particular point in time. And when you use the buy term invest the difference strategy, there's no way you can guarantee the dollar amount that you'll have in your investment strategy. So you can guarantee if you pass away during the time frame of the term insurance that you'll get the death benefit payout, but you cannot guarantee the amount of dollars in your investment strategy. And that's because of the just the different levels of risk. So when you have volatility, you have the potential of loss, you don't necessarily even have a guarantee that you're going to have more than you've invested, or equal to what you've invested. You can lose money. You can actually go backwards from what you've put in your seed capital, your inputs into your investment strategy. And so when you look at that, I think there's something that we've talked about multiple times on the show before, but there's a difference between a historical average, which is then usually said something like, oh, well, you can get 8%, or you can get 12%, or you can get 7% average because the stock market's performed average in the past, depending on your time frame. What that historical average is, that average is arrived at by adding the positives, subtracting the negatives, and then dividing over the time period. So whatever the returns are, positive or negative, you're just doing a simple mathematical plus minus calculation, and then dividing over whatever it was, 20 years of those returns. And that's a mathematical average. You can't take that number and expect your investments to perform on a guaranteed basis with that positive number every single year. And it's very fallacious. Is that a word? It's a fallacy. I'm making up words here. It's a problem to have. It's faulty logic. It's improper reasoning to think that you are going to get an average going forward, or to assume even that a positive average historical rate of return means that I will generally average this in the future going forward. And I think the easiest way to think about this is that if you take $100 and you get a 100% return in the first year, that's going to be, we're now at $200. And now we have a 50% loss. Now we're back to $100. We've just broken even. If we had returns of plus 100, negative 50, we'd be in a position that we would say, well, this is, let's look at the rate of return on that. So plus 100 minus 50, that number is 50. Divide that by the 2 years of that time period. That's a 25% rate of return. So I should have more money than 100 that I put in, right? Because it's a 25% average rate of return. Wrong. We just said we went from 100 to 200 back to $100. You have exactly the same number of dollars, the amount of money that you put in the first place, and it could be argued that you even have less if inflation has occurred and you're in a position where that $100 buys even less 2 years later than it did when you originally put it in. It was nothing like a positive 25% rate of return. So it's very challenging to use historical averages to make conclusions about what you think your investments are going to do, especially when you don't control the investments and you're not actively investing. It's not something that you are in you have boots on the ground and you understand the investment landscape. So Bruce, I know that you have a lot that you probably would add to that with the whole sequence of returns risk. So how can we think about that from a healthier perspective?
Well, I think if you go back to what Dr. Wade Fowle was talking about, is that there are periods of time in investing, in traditional investing, that you do not get very good rates of return or any rates of return or negative rates of return. This is very prevalent in the 2000s when you had the dot-com crash in the early 2000s and the Great Recession in 2008. And if you look at the S&P 500 over that time period, I believe it was about 0.79 over that 10-year period per year, 0.79. So then if you, in a retirement situation, or just because you need money to do other things, you actually take money off your portfolio at 4, 5, 6%, and it's only growing by 0.79%, then it's actually going backwards, and you actually have to make a heck of a lot more money to overcome the losses just to get back to even, because you're taking money off of it also. So you have to summarize that, you actually have to, the stock market or the investment has to make up for the loss, and it has to make up for the amount of money you're taking off of that particular. And that is really detrimental in somebody's portfolio if they're just going into retirement. So they have X amount of dollars, they lose a lot early. It's hard for them then to make up that loss over the next X amount of years. However, if the sequence is you've gone through retirement for about 20 years and then you have a major drop, now because you're closer to mortality, it's not going to hurt you as much. So what Dr. Wade Fowle says is, and he's proven it with 50 Monte Carlo simulations, which is really just a way to back test and see how these investments have done over the last X amount of years. He says that if you would have not have taken money out on the down years, then you actually can mitigate the risk of sequence of return risk. Well, everybody should be shouting at the podcast right now and said, yeah, but I need my money out of my investments at that time. And he said, no, what you have done over your career is you've actually saved money in whole life insurance. And now in the down years, instead of taking it out of your investments, you take loans against your whole life insurance and you live off of that. That way, now the stress on the investments is just to overcome the investment losses, not the additional money you take out. Now, if you're an astute person, which our buddy Fritz always is listening to the podcast is, you would say to yourself, now, wait a minute, but if I would have had that extra money that I put into whole life insurance and I would have been putting it into the investments, I would have even more money. And Dr. Wade Fowle says, well, wait a minute. That actually is not true, because what I can teach you now is you can actually do more equity or not as safe of investing, because your safe investment money is in your whole life insurance, and that it can actually recover faster that way. So he had thought of all those different variables in his research. And I think that is really what comes down to. We're not saying buy term and invest the difference can't work. We're just saying there's a sequence of return risk brings that into a reality that it may not work for you. And there is an alternative to mitigate that sequence of return risk.
Mm-hmm. Bruce, I think there's so much to this. And I think as we continue to explore the conversation, I mean, clearly you and I are proponents of whole life insurance, but it's not because of any other reason than it is a very powerful strategy for overcoming a lot of these challenges and really being able to put people in a better position with more guarantees and more confidence for the future. And so I think it is challenging to maybe shift a mindset that you have already if you're in a position of saying, well, whole life insurance just isn't for me, or it's too expensive, or I should, just put my money into term instead and invest the difference. So we're helping you be able to think through what that actually means. There's two other things I want to bring in really quickly as we're coming to a close here. But Bruce, you mentioned this before, that the returns in your investments may be taxable. So often when you do see a rate of return that you're going to get in some mutual fund or stock portfolio, you're in a position where you're seeing maybe the historical average. So we've already showed how that historical average can be really misleading. It doesn't mean you're going to get a positive growth of that number every year going forward, but also what it means, in addition to that, that you might have low down years in the beginning, which are really hard to overcome. It also means that you're probably not seeing in that number management fees or the impact of those fees that are going to be taken out. And so you're not going to experience that full rate of return. It also isn't usually showing how that investment is taxable. So if it's taxable, you're going to have to reduce again what your projected return is. And when you look over at whole life insurance, we're not going to get into a lot of the details of the taxation, but it's a powerful tax tool. There's a lot of tax advantages. As this cash value is growing, tax deferred, you'll pay tax in the end if you take out more than what you've put in, more than your cost basis. But the point over here is that you can look at your cash value growth and know that that is the return or the amount of cash that you'll have after tax. If you pay tax on the seed with whole life insurance, you'll not, and you use the policy properly, you won't pay tax again on that money. So what I mean is that you have it grow tax deferred. As long as you use it properly, you will be able to access that capital tax free. And then you also have the death benefit payout to your heirs income tax free. So you have a tax advantage on the insurance side, where if you look at the cash value amount that you'll have, that is already accounting for, it's a net of all of the things that the investment returns have not yet taken out, things like taxes and fees. The other thing I want to mention is that with a whole life policy versus your investments, depending on where you're putting your investments, you may, on the investment side, have to pay additional fees if you want to access your capital early. Usually this is in qualified plans. And if you're accessing before the age of 59 and a half, or you're withdrawing, you have to pay a early withdrawal penalty on that capital. Whereas with cash value and a whole life insurance policy, you have access to that capital in multiple ways. The ideal way is to borrow against your policy. Again, we'll leave that for another conversation. If you're not familiar with that topic, we'd love to be able to unpack that in future episodes. We've done that in the past as well. But you are able to look at the cash value dollar amounts and recognize that that is already accounting for things like taxes and fees. You don't have to reduce them out of your cash value dollar amount. So that is something that gives you a powerful advantage to then say, what if buy term invest the difference has all these problems and challenges? What is the opposite? What can we do instead? And what we would suggest is to think about insurance, not just as insurance only, because the cool thing is, or maybe it's cool, maybe it's profound, is that if you use whole life insurance, that doesn't mean you are prohibited from investing. It doesn't mean you only put money into a life insurance policy. You have the ability to use that as capital to fund investments. So you're in a position where you can use that capital in two ways. It's an and asset. You can put your capital into a life insurance policy, you can borrow against it and use that capital in outside investments. And so Nelson Nash is really the beginning thought leader on this whole idea called becoming your own banker. And I think a better mantra, rather than buy term invest the difference, would be become your own banker. And I'm just going to give that back to Nelson Nash. He really made this known and popularized and brought it out to the public to say, you can put cash into a whole life insurance policy and not just think about the insurance component, not just think about the fact that you'll get a death benefit payout whenever you die during the span of your entire lifetime. But the most important thing is that you have a need for capital and accessing cash all throughout your lifetime for any kind of purchases. And if you have a tool to store capital powerfully, this savings tool is more valuable to you when you think about your entire personal economy. And when you put guarantees around that tool of savings, you're in a position where you have access to capital, and that puts you in a much more advantageous position. So, Bruce, anything that you want to add to that as we wrap up here?
The last thing, just because I haven't talked about it and it was kind of impressive. Death benefit claims with life insurance and annuities in 2022, according to LIMRA, were $797.7 billion in 1 year. So that's a almost 8/10 of $1 trillion. So once again, I think a lot of people have this negative attitude about insurance because they think, oh, these insurance companies are never going to pay it. I've heard this before, especially during the COVID regime. Oh, they're not going to pay. There's only one time that in the contract that they say they're going to not pay it, and it's not even in every state, is if you commit suicide in the first 2 years. And any other way you die, whether it's a complication, whether it's your fault, whether they pay the death benefit, it's in the contract. And so I've often heard people say, well, that, I'm not chancing the insurance company not paying me. And I think that is an irrational way of thinking.
Absolutely. I do want to bring a few comments in here. Fritz, thank you for joining in. We've got Becca Wilhite as well. So a few here. Fritz says a mutual insurance company does not see a whole life insurance policy to funnel dividends by accident. The mechanics of a whole life is the reason why the company chooses a whole life to do so. If you think life insurance is expensive, the inflation tax because of fractional reserve banking should wake you up. Yes, that's absolutely true.
That's another podcast.
I know. We'll screenshot this and we'll talk about some of these in the future, Fritz. Thank you for your fodder for additional conversation. He also says you lose time value with short-term thinking and short-term strategies. I mean, Nelson Nash always just said, think long-term, think long range, think as long as possible. And yes, of course, if you make a decision for what's best for you right now, this year only, this month only, this week only, you're not going to really consider the implications of that decision and whether it was really the best decision or not. So if you think about what would be the greatest benefit to you 75 years from now, whether you're living or not, what would be the greatest benefit to your family, you're probably going to be thinking more proactively and in a better position. Fritz also says, in an economic downturn, capital is squeezed out of the economy. With insurance cash value, you will have capital advantage. And then Becca Wilhite says, buy whole life and invest the cash value. So there's a new mantra: buy whole life and invest the cash value, because you can do that and you can do it powerfully, and it can improve all of your financial outcomes and make you wealthier, make your family wealthier in the future. And so you're planting seeds that will reap a long-term harvest of wealth in your family. So thank you for being with us on the podcast today. If you want to apply these strategies and be able to think through your own life insurance needs, go ahead and book a call with our advisor team. You can do that at themoneyadvantage.com, and we will talk with you about everything that you have on your hopes and dreams and goals, what you're working with, and come up with a strategy to make sure that you are equipped for optimizing your finances going forward on a long-term basis. So with that, let's close here, Bruce. In closing, if you're listening, please remember, success leaves clues. So model the successful few, not the crowd, and build a life and business you love. We'll see you next time.